Underwriting deals is such a major pain point for people. Most don't want to do it, and the people that are good at it are few and far between. That is why after 6 years of being in the industry and buying over 1,200 apartments, using my best-selling multifamily deal analyzer, I created Real Estate Lab, a full suite acquisition software for multifamily investors. We have built a product that helps investors automate their acquisitions and close more deals, all in a cloud-based platform. You can go to realestatelab.com and sign up today using the promo code TAG2 for 10% off your first 12 months. This is David Tupin. Thanks for listening.
Welcome to The Apartment Gurus, where twice a week, host Tate Siemer brings you deep dive interviews with the wisest gurus in the apartment investing industry. These experts are sure to create game-changing value and inspiration designed to catapult your business to the next level. Be sure to reach out to Tate at www.investwithgreenlight.com for access to his investor portal and Calendly link. And now, here is Tate Siemer and the Apartment Gurus.
Welcome, everybody, back to another episode of the Apartment Gurus podcast. And I've got a guru who's calling in from Orlando, Florida today. And today is September 28th of 2022, the day we're recording this. And unfortunately, Orlando is facing a storm that's coming in, pretty big one. Ian, I think, is the name of this one. So unfortunately, all thoughts and prayers to you and your family and your friends, Ray. I'm sure everybody will be okay.
Thank you. No, we're ready to rock and roll. I mean, we've kind of written a couple of these out. In fact, the last one, my wife did it without me. So she's just happy to have me for this one.
Yeah, well, good. So we've got Mr. Reyes, and Ray is spelled R-E-Y, and Reyes is R-E-Y-E-S. Mr. Reyes, and he is president of the MI Real Estate Group, and they are they invest in multifamily properties. So Ray has been actively investing in residential real estate since 2005. And is focused exclusively on multifamily since 2016. Man, I wish we had gotten in 2016. That would have been awesome. We waited till 2018 before we really got our gears going. But he has led MI Real Estate in investing in 14 multifamily properties in Alabama, Florida, Georgia, Texas, and Tennessee. Over 900 units, valued at over 100 million. You've reached the six-figure plateau in your assets under management, sir. Ray also provides independent consulting to multifamily investors and is the best-selling author of a book called BLUF, B-L-U-F, The Bottom Line Up Front, about passively investing in multifamily properties. So, Ray, welcome to the show, dude. It's really great to have you. I'm excited for this conversation.
Me too, Tate. Thanks for having me, man.
Yeah, my pleasure. So, before we kind of dive in, I know you've got a fascinating story with your military background and things you've done in your life. Could you just kind of give us a thumbnail version of Mr. Reyes's path through life, and then especially in real estate? We'd love to hear, kind of how you got to where you are today.
Yeah, absolutely. So Reyes starts out in Puerto Rico, where I was born, was raised there till about 7 years of age. We moved to Milwaukee, Wisconsin, because essentially we had a few family members that moved there, and it just happens, right, organically. And frankly, it was one of the, we were very blue collar. It was one of the cheapest tickets to move the family over from Puerto Rico. A lot of jobs at that time, a lot of industrial jobs that were available. So that's kind of how I got there.
What year was that, Ray? Sorry to interrupt you. What year was that? That
was so you're gonna give me my age on here. So yeah, it was 1979 when we moved, right? So
We're the same.
was,
We're exactly the same age. Yeah.
Okay, cool. Well, no, so 79 is when I moved, but I was okay. So you're 72?
I was actually born in 73, May of 73.
Right.
Yep.
Close enough, man. So good.
Yeah,
so,
pretty close. Yeah.
We're about there at the half century mark.
That's right.
We're just getting better with time.
That's right, man. That's it. That's the name of the game.
Yeah, you got it. So, I mean, honestly, I'm the kid that growing up, loved the game of Monopoly. I like the concept of it. I still remember when we bought our first house. It was exciting, and it kind of those kind of memories. And the hard work that went into buying that house. It kind of was all part of my past. And then I joined the service as a reservist, as National Guard member, to pay for college because, frankly, we didn't have enough. It was just a reality, and it ended up being something that I really liked to do. And so I got the benefits for the military, and then I went and did my degree and got my commission. And 28 years later, here I am. Along the way, invested in single family, like a lot of military service members do, and then got deliberate about jumping into multifamily as soon as I realized that was a viable path. And boy, kind of like you said, wish we started early. That's exactly right. Just when the light turned on, it was probably about 3-4 years later than really when this started with the Jobs Act. I think it was 2003 when, honestly, most middle class people could get into these type of investments that did not require folks to be high net worth earners or, what we call accredited investors. But hey, late start is better than no start at all.
Yeah. Good job. I don't think we're old, man, just for the record. I think 50 is the new 30. I still feel like I'm 35 most days. But you do see some signs of change here and there. I get that, but I do think that it's a mentality. And I think, even if, no matter what you believe about it, statistically, we've still got a lot of runway in our careers and our businesses. And we've got a lot of energy. If you're anything like me, and I can tell that you're real passionate about this. And you love this, like, you're smiling this whole conversation. And I can tell that, when you are the lead sponsor on 14 community transactions totaling over 100 million assets under management, 900 doors, like you're almost to the 1,000 mark on that. That is exciting stuff. And when you have that level of success, and I know it's come with mistakes, I'm sure, is my guess, and I'm guessing that there's been some harder lessons along the way, but nonetheless, like, just congratulations, man! Like, way to go, get it.
No, thank you. And just to clarify, I don't want people to think that I was a lead sponsor on all those. In a lot of those, especially in the beginning, we were essentially just general partners. Yeah, that's kind of how we got started. Okay. But along the way, you get a little smarter and you dig in deeper. And in my case, where I would, essentially I became a full-time investor, I was really kind of able to get in completely and figure out what I wanted to do and what I wanted, my partners and I to be able to achieve and then be able to kind of pass that on to people that didn't have the liberty of that time or really, frankly, like you said, the will to learn about this stuff. Because people want to make money, but not everybody wants to be involved in real estate. They just don't. But they do see it as a viable mechanism. And I strongly recommend folks diversify out of some of these other types of investments into hard assets like real estate. Because you just can't make real estate up. It is there. And that's kind of my land. I was an Army guy, so maybe that's kind of my Army mentality a little bit. But, we could always have the Air Force, when we're doing operations. Air Force always did their part. But honestly, you can't take ground from the air. You need to take it from the ground. And so it's always stuck with me.
Yeah. Yeah. I mean, the magic of real estate, right? That's kind of why we're all here. And I think, in particular, the magic of the multifamily space. I want to ask you about two things. When you were in the Army and you started investing in real estate, what was your inspiration to do that? Did you read a book or hear a podcast or have a mentor or something like that, like an example in your life? How did that come about?
Yeah, as I mentioned, I don't know. I just grew up with that idea that you could make significant money and build wealth for a family through real estate and monopoly. The idea that you start off and you rent a house, you land on it, you buy it, you rent it, and then you build it all the way until it becomes a hotel. It's a basic concept, but it is really the basis of what it is that we do, right? Obviously, there's, you get into multifamily. I kind of went through the single family piece, but I don't know that there was a particular event that kind of got it going, other than I do remember when we first bought our own house and the feeling of, I don't know, to be an owner of something was a great feeling, especially when all you've done is rent. And we moved around, and then all of a sudden we had our own house. And between that and just my own, I guess, upbringing and some things that I probably can't even point to, but are critical in that. Yeah, I've always enjoyed it. I felt this is a good solid path.
Well, and it is. And, I think some of us, Ray, are just kind of wired this way, like you and I are, when the pride of ownership, the excitement of owning an asset that cash flows, a rental. Obviously that's not true of your primary home, but, that's the Kiyosaki game, right? Like the rich dad, poor dad game is acquiring cash flowing assets. That's monopoly, right? That's like what you do in Monopoly. I love that. It sounds like Monopoly was pretty formative for you in terms of kind of instilling some of these concepts and like giving you a love for the game.
Yes, it was. Yes, it was. And another one that I think, so you mentioned Robert Kiyosaki is the cash flow game, which is, the whole notion of getting out of the rat race. Yeah, there were a lot of books along the way. I don't want people to think that there was no learning and education. There still is, but it is not something that you can typically find when you go to a university. You just, people aren't teaching you this, and certainly in high school they're not. Right. So you got to learn this on your own and need to have that will. But even if you don't, find somebody that does and align with them and figure out how you can make money together. I mean, at the end of the day, it's about.
Right. Partnership, right? Like I've said before in presentations I've given to audiences and whatnot, that anything that you need for your deal to get it done is available in a partner, whether that's sponsoring the loan, funding equity, funding earnest money, even the relationships. You can leverage other people's experience. They're like you just alluded to, Ray. You can leverage their expertise, and you can learn from them. Like I think like you said, this is not stuff you learn in school. This is stuff you learn by going out and doing deals. And yes, there's tons of great stuff online. There's great podcasts. Hopefully this is amongst them. By the way, I haven't announced this yet. We were just named number 3 of 40 top apartment podcasts, apartment investing podcast. I could not believe that. Like, that was FeedSpot is the source that ranked all of them. And man, it's very humbling. Some of the people that are on the list are just huge players and people that I've learned from and been inspired by. And so, so anyway, quick news flash there, but, partnership, it can't be understated, the importance of the network that you have being your net worth, because you can leverage other people's net worth literally, when you go and apply for a loan. That's how it's done. That's how these things get done. So yeah, exciting stuff. So tell me a little bit about your team now. So I know your wife's involved because her initial is part of MI. And the I, by the way, stands for Ismael, and that's Rey's, I guess, given first name, right? Just like my given first name, by the way, is Dale, of all things. That's my dad's name, but they've called me Tate since day one. So anyway, yeah, tell us a little bit about your team and how you guys work together.
Yeah. So initially, when I was still in the military, we formed MI Real Estate as a way to frankly initially acquire single family homes and allow for asset protection as we were getting more properties under our name. It comes a point where it just becomes something that you want to do. You have to have some sort of policy, either an umbrella policy or some other way to ensure that if this is a litigious society, and people sometimes there are a lot of reasons. Positive reasons why people sometimes sue. They're not always negative or wrong, but there are a lot of people that are trying to take advantage of the system. So we were trying to protect ourselves, but that kind of ballooned into, into essentially an operations company where we essentially run all of our business through there. We don't essentially own assets in that company anymore, but it is how we kind of manage things operationally. What we've done so far is we actually created, in this business, especially in real estate, every asset essentially in multifamily has its own limited liability company or company where it is held. And so it provides, innate protection to people that invest in these because their name is not on the books, which is great. So it provides some of that. But so we create a ton of different entities. Our current operations really, MI Real Estate is joint venturing with several other partners, and we created a joint venture company called the Admirable Group. And in the Admirable Group, there's 5 partners who are involved in all the facets of acquiring assets, right? And so we have asset managers, that's their focus on a particular asset. We have folks that are involved in marketing, so the whole gamut. So when we go into a project, you said not one person can do it all, but you build the right team around you, and you give yourselves certain areas where you can focus on with some bleed over, because you have to have some bleed over, but that allows you to really grow and go after bigger assets and really leverage other people. I mean, one of the books that I like, and every once in a while I got to remind myself to go back and look at it. It's a book. It's called Who Not How, and who is trying to think of the Dan Sullivan. I couldn't think
Sullivan.
of it.
That's such a foundational book. That book comes up an awful lot on this show. Yeah.
Yeah, because essentially that's how you got to look at these things. You figure you have at some point you reach the limits of what you can do. I mean, and on a single family space, frankly, a lot of people can do the whole thing by themselves. You can go through and buy a property and rent it and go through that process. It's a lot of work. You're essentially giving yourself a part-time to a full-time job, depending on how difficult the property is. But essentially, I mean, that's what this is about, is how you can build that team around you. And it's not just people. I mean, people was one thing, and anybody can fill a particular gap, but you have to have people that align well with you. Not just on a professional level, but also on a personal level. There's just so many things that go into place. But at the end of the day, you have to be very careful when you get into partnerships, but it's essential to the business.
Absolutely. And well said. And I recommend that people start out partnering on a deal by deal basis. Don't necessarily get into bed with somebody on a long-term agreement right away, because there's really no reason to when you can do deals together. That's really what you're doing anyway. So that's what I recommend starting with.
I agree completely. I mean, I think that's the best way to do it. And, not every experience doing it that way is going to lead you to, wanting to do future deals, but it does allow you to filter. You filter, you work with some people and you figure out whether this is something you can continue to work with them on, or not. I mean, I had one group, I'll give you an example. We one of the first ones that I started working with, they wanted to go in a different way. And after we got going, we had some very good deals, but they wanted to become kind of a family office. They wanted to get vertically integrated into a lot of other things. They wanted to buy a property management company. And essentially they kind of went a different path. So at that point, we amicably just kind of separated. I mean, it wasn't, this huge disagreement or anything. It just, we didn't align anymore. So sometimes even when you do align, in the future, that alignment may change. And so these joint ventures have to be flexible. And frankly, with these properties, with these acquisitions, they are, because like you said, it's really one acquisition at a time. Now, I do caution people to have too many partners, because it does also reflect not in the best light to potential investors when they talk about who is on your team and who you work with. If you've got 5 deals and you have 5 different teams, that's kind of a tough one, right? So you do want to eventually align somewhere where you're comfortable in a niche, and we'll work from there.
Yeah, well said. Yeah, absolutely. And so ideally you are working towards long-term partnership. And, to zoom out a little bit, like we talk a lot about how this is such a relational venture that we're on. The space is very, very relational. It's not as nearly as transactional in contrast, say like single family is. But your relationships are everything in this business. Your reputation is everything. BEERY, I mentioned his book a lot on the show. Fantastic book. And it's all about becoming an elite investor that people take deals to. And, he writes about this particular aspect really well. So, I just don't think it can be understated, the importance of your reputation, of your relationships. And look, when your approach to these relationships, listeners, especially, really is a long game approach, right? Like and the more authentic you can be in this game, the better. And the more interested you truly are in people, the better. That's kind of hard to fake. I think, but so you want to be somebody that's curious, that wants to get in other people's world and form a long-term bond with them, because ideally you're doing, like you said, Ray, you're aligning, right? You're working towards this alignment with your partners and your teammates, so that when you do go for capital and you're raising funds and that sort of thing, you have this really tight team. Everybody knows who you are, knows what you guys do, and everybody understands their roles really well. Like, yeah, all of that is extremely positive stuff. So sounds like you guys are really well poised to do some big things. Talk a little bit about that. Like what where are you guys headed? Are you working on any deals currently? What are you looking for? That sort of thing.
Yeah, no, that's a good question. So we are currently working on 2 deals. One of them will be a 506B, so I can't get into a lot of details on that one, but that one hopefully will be in Orlando if we get it to work. And I like to vary my 506Cs and 506Bs. I don't know how much your listeners know about those two, but essentially a 506C is the kind of deal that you can see people posting on LinkedIn, and they put it on there and they put it on social media, they put it wherever, and you are able to advertise that potential opportunity. But the drawback is you have to be an accredited investor to get into that deal. A 506B, obviously, you can have up to 35 non-accredited investors. So that allows a lot of people that wouldn't necessarily be able to get into this game to really get in and start reaping the benefits of scale. So I try to balance those, one of each if I can help it. And in fact, I'm looking at potentially doing a hybrid where we can go into a deal, essentially make it a 506B, close that out, and then turn it into a 506C. So we would give a limited window for non-accredited investors to get in on these deals, on every deal. It's a little bit more costly, But I think it does allow us to bring in some of these people. And that's something that I enjoy. I mean, it's great to work with, with high net worth individuals. That's fantastic. I mean, I'm working with high net worth individuals from here in the US and also from overseas. But there's something special about working with people that are growing into that high net worth investor, and they're working hard. They may be blue collar, they may be middle class, and are looking for that way forward. And to give them an opportunity and see that blossom is special to me, because at the end of the day, and I'm not trying to get on your show to brag, but I can stop doing this tomorrow. I mean, I just can. I mean, I don't have to do this. I have my pension. I have my own investments. I can ride that until, to the sunset. But there is something special about that. And of course, at 50, who wants to do nothing for the rest of their life?
Right. Yeah. I mean, it's so much better, I think, to have either a serious hobby or a business or a vocation that drives you and excites you and lifts you to be a better version of yourself, which I think this space really does. So on that note, you make a great point, and a lot of the guests that I have on are in similar situations to you, where they could quit tomorrow. They've got beaucoup cash flow and incredible net worth and that sort of thing. But they're some of the biggest players in the industry still. So something's driving them, that aside from subsistence and getting to a lifestyle that they love. They likely have everything in their lifestyle that they want. So it just kind of begs the question, for me, it makes me curious about you, Rey. Like, what is it that drives you? You mentioned being able to offer people the opportunity to invest in these assets that are so advantageous, and to be able to do that with 506B investors that aren't accredited. You're right. That is a really exciting thing to do. If people invest, $50,000 and they're doubling that in 5 years, kind of thing. So, along those lines, what else is it on your end that really kind of lights you up about doing this?
Yeah, no, it's a good question. I mean, I kind of feel like, okay, it's like, it's the advantages of being an athlete, a superstar athlete that, let's just, I hate to throw names out there, but let's say Tom Brady.
Sure.
Tom Brady, if you're a football fan, the guy's been around forever. It's like, he doesn't need to play another year. He just doesn't, but he feels like he still can. And some would argue yes or no, but he's still playing at a very high level. Yeah. And so you're going to stop doing that to do what? I mean, it's like, this is what's gotten you there. This is what you like doing. Otherwise, he wouldn't be as good as he is. So I think that translates to some extent to folks that are in this game, because you do go through a process of learning. You never stop growing. But I guess the best advantage for us is that, so long as the brain can continue to process and continue to learn, we don't have to be as reliant on those physical tools as people, had to do in professional sports. And certainly I had to do in the military for a long time. And so to be able to continue to do that, I think it's just part of the way we're wired. It's like you said, and you can't turn that off. That level of competition, to me, there is a certain benefit. I like going after deals. It's just an exciting thing to go after deals, and not just any deal, because anybody can go out there and throw some money around and see what happens. But to really find one that is a gem, and then be able to turn that and give others an opportunity to get at this thing, and then see the back end of it, right? Because here's a key. Like, even if nothing else sticks, when I build my wealth, it allows me to share that wealth with my family, my friends, and it allows me to give more to strangers. Yeah. A broke person can't give. I mean, that's just the truth. I mean, you can go out there and do some physical labor, and that's a way to give. But if you really want to multiply that, you have to grow your own savings. You have to grow your own wealth so you can give it away. And so that's what I like, because at the end of the day, even though I'm okay to stop, it's okay for me to stop. I know that the more I do, the greater the overall benefit to others as well. And so that kind of drives me.
That's awesome, man. That's a really, it's what I would call an empowering context that you have for that. It's because it's kind of like it's like a positive feedback loop where, the better you do, the better everybody else does. And
Win-win.
so you're putting the momentum of your altruism and your empathy and your desire to contribute to others behind you doing better and being better and specifically growing your wealth. And dude, that's exciting, man. That is mindset. That's like Jedi to me, like really powerful mindset stuff right there. And so listeners, I think you could take a lot from that. If you've got a disempowering belief, you can re-script that belief into something like the better that I do, or the better that I do in life and in my wealth building, the better everybody around me and even people that I don't know do. And that's going to like flip the script on that disempowering belief. So that's something I work with my coaching clients on. It's really one of the first things we talk about is mindset and disempowering beliefs and really busting through those. So I love that example, Ray, that you have set there. So would you guys have at our company, we have what we call a vivid vision, which is a 3-year vision of where we're headed and what we're doing. Do you guys have, and obviously that has our goals in it and our mission statement and everything like that. Do you guys have goals? How do you set all that up?
Yeah, no, it's a good question. And it goes to something deeper for me. I feel like for the same reason I can quit at any time, I also don't have the pressure of having to get X amount of doors this year.
Yeah.
I think that's dangerous. I mean, it doesn't mean that, that if you apply it correctly, it's not a bad thing. But I think a lot of people translate that to like, if you don't hit that goal, you've done something wrong. And when you start reaching for deals, I think that's where things can go wrong, because you get into that gray area and let's do it, and you kind of go into that space where you shouldn't. You're clearly in the gray. You're probably sliding. The conditions on the ground. With the Fed doing what they're doing. Let's just use that as an example. Now you have to be very careful. You have to analyze things differently. And the minute you are, tied to a number, a growth number, I think you do become a little bit more susceptible to making mistakes for your investors and for yourself. I would say that, when our group gets together, we really talk about, just incremental growth, focus on incremental growth. How can we make, using another military or army term, how can we improve our foxhole? Our foxhole being, where we have to operate from. Can we create some processes? Do we need to hire some other consultants? What is it that we can do right now to make sure that we continue to make things better for us and for our investors? And I think that model of incremental growth, it's not for everybody. Some people want a 10x and 100x or whatever you want to call that number. But at the end of the day, I'm much more comfortable working from an incremental growth perspective in this business, because I don't have the pressure of having to put another deal in front of people. Now I've got investors that are like, hey, when's your next deal? And I got to tell them, listen, as soon as I have one, you'll be the first to know. But we are being careful, and they appreciate that. Now, some of them may invest in another deal because the timing is better and they have to do something else, and more power to them. There are other people that are doing this and doing this very well, exceptionally well. And some of them have been on your show. And so I think the idea that, you're the only show in town, I think is wrong. But I think people do appreciate that my approach anyway, that, hey, I'm gonna be very ultra careful right now, as opposed to just jumping into the next deal just because, somebody's willing to sign a contract. And so I think it's important. And I just had a call from an investor. We are actually on a deal right now that essentially is out of contract. We had it under contract. It's out of contract because at the last moment, the lender fell through when the Fed went, initially nuts and kind of pushed a lot of people into out of contract and kind of figuring out where to go next. And I have an investor that's sitting with money in escrow on this deal to close. And I told him, I said, listen, I can return your money tomorrow if that's what you want. I can do that. Or if you need it, you want to invest it somewhere else, it's there for you, because at the end of the day, your money is only good. It becomes hard when we close. As up until that point, it's there. And he said, I was looking at another deal. He mentioned the deal. I won't go into that, but it was actually a deal that I looked at and I decided not to participate in as one of the partners on. And he's like, and I mentioned, I said, that's a good deal. That's a good deal. He's like, yeah, I looked at it, but at the end of the day, what came to him in his mind, and he said, what came to me, Ray, is that I don't know those people. And ultimately, I don't have time to be paying attention so closely to these things. So I want to work with you because I know that you're going to do the right thing. And I know that you've done the right thing, and you've told us, and you communicate with his wife is actually very active in their passive investments. And and telling me this. And I'm like, listen, I value that trust. And that's the most important thing to this business is trust. I just wrote a blog article about partnerships and trust. You have to have trust between yourself and your passive investors, your partners that are making these deals work. And then you also have to have trust between yourself and your other active partners in these deals. Essentially, that is the main building block to these deals working well, is the trust that you are able to build and sustain over time with both. And so, I can't overemphasize that enough.
Dog was excited about that last point you made on trust. Dogs are very trustworthy. So he got excited. So cool. So right now, you guys, do you guys have stuff in the pipe at different stages, or what are you working on right now? Are you pencils down?
We've done a lot of selling. We sold a lot of stuff in Tampa. Tampa went through a rapid rise over the last few years, and thankfully we were able to get in at the right time. And when I look at Tampa now, it's kind of like, holy smokes, $120,000, $115,000 for a C class. We were buying in the 60s, 50s, and 60s. So it's just and we're talking 3-4 years. So this hasn't been a long-term thing. So it's great. I think we are seeing some opportunities come up. People always, when we have these issues where there's contraction in the economy, this is obviously a contraction that's been driven by the Fed. But when you have a contraction in the economy and housing, people kind of freeze up. They go like, oh my God, what do I do? I'm not going to do that. It's crazy. But honestly, a lot of money is made. The big money, the big wealth is bought in the downtime. Because you're not competing with everybody. Everyone's kind of stuck. So if you're able to operate in that environment, you're able to, adjust to take advantage of it. So the rates are higher. Look for price reduction. There's a lot of retrading going on right now because of price, because the rates keep going up. Look for some alternate, solutions to loan to lenders. I mean, you don't have to do a bridge where you have a $700,000 rate cap.
Right.
And I don't know how much your
there's bank loans. There's good bank loan programs out there right now that are fixed rate for 5 years. And I mean, there's always seller financing too, seller carryback.
Yes. And so you just have to know how to work in these spaces where everyone else is on the sidelines, and you got the field to yourself, to you and a few others. Right. And there's just a lot of places, because I think what hasn't changed, and people forget this, fundamentally, we are in a much different place than we were in 2007, 8, 5, 6, 7, 8 to the, in that time frame where we had the last major correction to housing anyway. We had an extreme amount of supply and not enough demand to start that. That's kind of what drove it. And then, of course, there was some very easy financing to people that probably shouldn't have got financed. That's not the case right now. Well, that's completely different. Regardless of what the Fed is doing, you still have a deficit in housing supply. There's a huge deficit. And frankly, this is actually actually adding to that deficit, because you've got a lot of builders now that are on the sidelines too. They're like, well, wait a minute, I got to make my money, so I'm not going to build because it's costly to get the loans, et cetera. So the Fed is actually, by solving a short-term problem, is creating a mid to long-term bigger problem. And honestly, the ups and downs. I mean, the Fed essentially was involved in quantitative easing during COVID. It kind of helped them, helped us kind of get through that period. And now they're on the other end of that, where they're like, well, we need to cool down this inflation, which, of course, they were saying for the longest that it was, this is temporary. This is not going to stick. And now all of a sudden, about a year ago, they're like, well, wait a minute, we have an inflation problem. Now we got to put the kibosh on the system by raising the Fed funds rate, and then also buying back. So quantitative tightening that's going on. But all that's doing is creating more housing deficit. So in the long run, the people that are investing now and they're figuring out ways to ride the storm are going to do so much better later when the system stabilizes again. And we have an election coming up. So I suspect that by the end of next year, the Fed is, I would say by middle of the year, we're kind of going to be looking at a major, let's say a major recession, but a recession that most people would agree is a recession. Some people would say that there's a recession now. There was a technical recession when you think about, the actual definition, but we had an excess of labor. So unemployment was really, really low. So some say, well, there wasn't a recession because of that. Well, this is actually going to create additional unemployment. People aren't going to be able to hire. They're not going to be able to take loans. It's going to grow that unemployment number, which will hopefully stabilize. The Fed wants, kind of stabilize things and stop some of that rampant inflation, so it doesn't become something that it's just people expect to continue. But yeah, so I think right now is a time to actually be careful, find the deals, work hard, use your analysis and your tools that you have at your disposal, and figure out a way to get into some deals, because they're going to pay off in the long run.
Not to mention, and all that was just brilliantly said, but not to mention the sheer hedge against inflation that you are making when you invest in a multifamily property in a time like this, in an inflationary environment. You are putting your capital into an asset whose value is theoretically going to grow because your net operating income is going up because rents are going up with inflation. That's a hedge against inflation. And listeners, this is a conversation you need to be having with everyone that you can think of. Why investing in multifamily is a hedge against inflation and how important that is. And like you said, Ray, if you figure out how to do this and do this well through this time period, you're going to be set up for when things start to shift and interest rates start coming back down and cap rates start coming back down again. You're going to be, because you're going to, number one, you're going to own property. It's going to gain an equity probably pretty quickly on the next uptick. Who knows, but that would be my guess. So, I'm glad everything that you've shared, Ray, here is affirming for kind of Greenlight, my company, what we do. And we're still very much, we're looking for those good deals, and a good deal is a good deal in any market. Obviously you need to pay what your criteria is, and that, is generally, it's based on it's based on the market and what the market will yield in a lot of cases, but you're going to find distress situations, value add situations, I think, in large volume in the next 3 to 12 months. I think we're going to start seeing some really unique situations that need our help. So your thoughts on that?
I agree. I think there are going to be some deals to be had. Essentially, the runaway pricing points that we were seeing are just going to be hard to sustain. And then you're going to have some folks that were sitting on bridge loans, that were they may have been in their first or second year.
Yeah.
And they were just hoping to just refi and cash out big time. Well, now the refi based on the new rates may not be worthwhile to refi. So what do? You sit in the property longer? No, you may take less money and get out and refresh yourself than it is. Others are saying, well, maybe the best way is to get an assumable loan. Okay, well, you do have to have more cash to come in and take over an assumable loan. So
because your LTV on an assumable loan is not going to cover nearly as much of the new purchase price. Yeah,
correct.
Yeah,
correct.
Totally.
So yeah, there's going to be some opportunities to be had. That we are already seeing that. And so it's just a matter of are you willing to put yourself out there? Because not everybody is. Some people are more risk averse than others, and that risk aversion, that just means that those that are willing to take smart risks are just going to make more. That's just nature of this beast.
Yeah. Yeah. And, again, the kind of listener that this show attracts are going to be a lot like you and me, Ray, like, as far as being risk adverse versus being risk tolerant, right? Like, I think most of us are probably a little more on the risk tolerant side. And when you have that and you see a change like we've seen, you start to see opportunity instead of like fear and risk and the doom and gloom that you're going to hear in media and other places, at the water cooler and whatnot. Like, so exactly. I think now is a time, like you just said, I can't remember exactly how you said it, but doing good deals, like just finding the good deals that, and don't push your underwriting, don't push your criteria, stick to your guns, right? Like, and find the deals that work well, because especially, coming out of this environment that we're going into or have been in, it's going to be an exciting ride, I think.
Yeah. I mean, I think you're right. I mean, the reality is when I talk to people and they're wondering whether this is a good time to invest, I just ask them a simple question. What do you do with your money? If you got money, where do you put it right now? I mean, where is it that you think that you're going to be able to ride out this, this correction? And I suppose you could leave it in stocks and not touch it for a couple of years and it'll come up at some point, maybe. But so will real estate. And in fact, real estate actually gives you some tax advantages now, and probably you essentially get the benefit of that inflation when you hold these assets. So they don't have a good answer for where. I think people just kind of freeze and they leave their money. I don't know if they just put it under the mattress or what they do with it. But I guarantee you, if you do nothing with your money, you're losing value of that money right now.
Yeah.
I mean, it's just you're losing, 6 to 10%, give or take, depending on whose analysis you take for just leaving your money in the bank. That's just the reality of it. So I think it's just pick your poison and think long term. And that's where the growth is.
You mentioned all the cash that's sitting around right now, not doing anything. What about all the equity in people's houses that is sitting around and rental properties, right? Like if somebody has a rental portfolio that they've owned for the last 5 years, like it went through massive appreciation depending on the market it was in. In a market like Tampa, huge appreciation. So that is equity it's lost opportunity if you're not accessing it. And there's different ways of accessing it. HELOCs, just a cash out refi, those sorts. Obviously selling is one way, 1031 exchanging, but that equity is opportunity. And like you said, Ray, it's not getting any, it's getting less valuable as the months tick off the calendar. Money's just getting less and less valuable right now. So access it now. And if you need any kind of help or guidance or advice in doing so, Ray and myself are both more than happy to consult with you on different options on getting into this. And look, I think getting in passively on a very good syndicators investment deal is a fantastic way of getting started in this space, no matter where you want to go with it. If you want to be a lead sponsor like Ray or myself, starting off as an LP with somebody that'll kind of hold your hand and show you everything that's getting done inside the deal is just a great way to learn. It's almost like a kind of an apprenticeship type program. So consider doing that. And by the way, you might double your money in 3 to 5 years as well. So great opportunity there. Ray, we're starting to run up against time here. This has been just a great conversation. I've really enjoyed it. What is the best way? I just mentioned, I kind of volunteered your availability to listeners, so I hope you don't mind that, listeners reaching out. Most of us love that. Like, we love hearing from our listeners. But anyway, what's the best way for somebody to get in touch with you and learn more about you?
Yeah, the easiest way is through my website, mirealestate.us. And from there, you can connect on all my social media. You can even get on my calendar. And I talk to people all the time. I mean, sometimes they, you got people trying to sell me stuff and they sign up on my calendar. And I'm like, well, wait a minute, this is for me to help those that are looking to potentially invest. But yeah, it's available. If you want to schedule with me, go ahead. If I have the time, I'll make, we will get on a call and discuss whatever it is you want, and whether you want to invest with me or not. You made a point about the essentially mastermind and talking about, a way to get into this business if you're not sure how to do it. And I think the method that you mentioned is my preferred method. Now, there's 2 ways, right? You can essentially buy a mastermind program, a full-blown mastermind where it could be 25, 30 grand, maybe more.
Yep.
Or you can LP on a deal with the right team that will allow you to grow and get your foot in the door with their network. Right. At the end of the day, what that mastermind does for you is it gives you the access that you need to move forward.
Yep.
And if you need that to move forward, go for it. I'm not telling people not to do masterminds. If that's what you need to get you to the next step, do that. But if you're fairly comfortable with numbers and you want to kind of learn and actually make money while you learn, invest in somebody's deal that's willing to spend time with you to show you the ropes about syndication, and be honest with them. Say, listen, I'm not exactly sure how to do this, but I think I want to do this actively. Can I start off with you and invest? And can you be available to me?
Yeah.
Because at the end of the day, if you just invest in somebody's deal as an LP, that's not going to essentially give you access to them unless you've had that discussion with them. But I have a lot of people that started out as LPs. Now they're my partners on deals. Yeah. And it's just not limited partners, active partners that have gone through that process. And now they want to get in on the active side because their life has changed. Maybe they were still working their W-2 job and now they transitioned to full-time. So all of those, but yeah, definitely, whether it's a mastermind or whether it's, getting in on somebody's deal and networking through there with the foot in the door technique, go for it. Don't wait. I mean, at the end of the day, those that wait, I end up having conversations with them at the beginning of the year, and they reminisce about they should have done something last year and they never do. Yeah. Don't be that person. Take that step forward and get in this game, whether it's active or passive.
I was going to ask you if you had any final words of wisdom, but that was perfect. Like, that's the perfect place to leave this, I think, because, so many listeners are either looking for a way to bust into commercial multifamily, or a lot of listeners are in commercial multifamily but want to scale up. And, this is such a fantastic way of getting in that Reyes just kind of outlined and illuminated with being a passive investor. And look, if a passive investor comes to me and says, I'd like to be on one of your deals and I'd like to learn, we'll have them come to asset management meetings with the property manager on Zoom meetings, and we'll include them in email chains. And like, we're an open playbook. So so you can really learn a lot. And I'm a coach. So like I'm kind of in the business of helping people learn. So, and Ray, I know you're such a giver, and I can tell that you're doing this for all the right reasons, to really make an impact and an impact on people that you don't know and you'll never ever meet, but you're still making a deep impact on their well-being and their livelihood and their lives. So dude, just again, congratulations on all your success. I want to be like you guys in 2 years is where we want to be, or at least, yeah, that's where we want to be, about 2 years. So,
we got to do a deal together, Tate. Let's do one.
Yeah, let's do it. I love it. Yeah, we're definitely game for that. So, but yeah, just, again, thank you for being on the show, and sharing everything that you've shared, with us. I think there was some hugely valuable stuff in there. And, again, mirealestate.us, right? Yeah. mirealestate.us to reach out to Reyes, who was our guest here on the Apartment Gurus. Thanks again, Ray, and thank you, listeners, for listening to another one of these and really enriching your business and your career by this digital mentorship. But one of the things that I think makes us a little different on the show is we do offer access to almost every guest, and certainly to myself. And we're here to help. Like, I'll legit email you our templates for our offering memorandums and stuff we're really in it for you to win it. So with that, again, Ray, thanks a ton for being on the show. It was awesome, man.
Tate, it was my pleasure, man. Hopefully that allows one person to reach out to you that wasn't ready to make that step.
And to you too. And look, you're growing your network, right? So it's not one conversation, it's 10 conversations, and set a goal for the week or the day, how many calls you want to make, and go do it. So, all right, everybody, coming at you twice a week right now with the Apartment Gurus. And so we'll see you here in just a couple days and with a new episode. So until then, take care, everybody.
This has been the Apartment Gurus with Tate Siemer. If you enjoyed this episode, be sure to subscribe and leave a rating and review on your favorite podcast platform. To contact Tate, go to www.investwithgreenlight.com for access to his investor portal and Calendly link. He loves to hear from you and thanks you for being a valued listener. Just a reminder that you are the guru. See you on the next episode of the Apartment Gurus.